guys, as I promised, this is the question that I want to do, comprehensive question that cover deferred tax. Okay, we have this company and they give us the information. You can go through the information, but I want just to go quickly to the note. We have the first asset that we have is a manufacturing plant that we purchased on 1st of July 2016, and it has a cost of 900, a useful life of 10 years. In the same date, we also recognize a decommissioning cost of 100,000, and this 100,000 is the present value of the decommissioning cost. Should it be the future value, then remember you're supposed to calculate the present value. They also give us information about the way SARS is allowing this specific asset, 40%, 20, 20, 20, and for tax purpose, the allowance is not apportioned for part of the year. Very important. However, the decommissioning liability, according to SARS, are only allowed as deduction when they are paid. Okay. The second information that we have is a delivery track. A delivery track that we purchased in 1st of April during our financial year, current financial year, for 800. Okay. And useful life 5 years, and SARS allow 4 years. However, this one for tax purpose, it is apportioned for part of the year. They also give us impairment of 50,000, impairment loss of 50,000 at the end of the financial period. So remember, when you're going to be calculating carrying amount of this asset, you're going to take the depreciation as well as the impairment of the asset. Good. We have our motor vehicle. We purchased a motor vehicle for how much? For 100,000. When? 1st of January 2017. And the useful life of this motor vehicle is 8 years. Okay, we sold this motor vehicle on September 30, 2018, which is during our financial period, for how much? For 120. Okay, so what we need to do first, remember, we need to get what is the carrying amount the day we sold it. Okay, and then we calculate if we made a profit or a loss. But already by looking, we purchased it at 100, now we're selling it at 120. You can see already we're selling, if we have to stand at the cost price, we're selling already 20,000 more. And for tax purpose, I just want to recall you, you're going to have a situation of capital gain. But when we're going to do the question, you're going to see that. They give us information when it comes allowance for tax purpose is 5 years, and it is apportioned as part of the year. Okay, they give us additional information. They give us a prepaid expense. In this case, for tax purpose, tax allowed deduction during the year where this expense have been, this amount have been paid. In our case, it's a prepaid expense, so we're prepaying for next period. And for tax, you say, okay, it's fine. I want you to deduct them the moment we pay them, not the moment you enjoy the benefit of it, if I may say like that. And we also have a income received in advance. Remember, income received in advance is a liability. So we receive an income, but we haven't earned it. But for tax purpose, no, I don't care when you're going to earn it, but I care when you receive it. So hence, tax wants you to tax or to have that amount taxed the moment you receive it. Okay, we have a warranty provision. Is a liability. A warranty provision for tax purpose, you want to deduct this amount the moment you made a payment. They also give us the profit before tax that have been given, and that profit before tax, the following item was taken into account. We have dividend received, we have funds, as well as the profit that we made on the sale of the motor vehicle. Okay, they give us also capital gain, 80%, as well as income tax. Good. And they also inform us that we need to ignore VAT. Very important, because sometimes the question, if they did not tell you to ignore VAT, you need to go back and see if there are some assets that you need to take VAT into consideration. Okay, let's go quickly to the memo. So what I did, this is just a Word document of the memo, but there is also another document where I did the calculation of this question, so you can follow those calculations. So I'll just go quickly this memo, but the calculations, you can see them attached on with this video. Okay, remember the first line item that you start when you're doing your your deferred tax is you try to check what is your accounting profit. In this information that they've been give us, accounting profit, it was 540. Okay, so this is our accounting profit. Good. Remember when we had our video, we say when we're talking about deferred tax, we need to look at two things. We need to look at, is there any permanent differences, or is there also any temporary differences? Permanent differences, these are differences that remain permanent. In a sense, the way that tax deal with them versus the way that accounting will deal with them will never meet. They remain the same like that. In our case, we add a dividend income. So for accounting purpose, we receive that money. We increase it in order for us to calculate our profit before tax. But for tax purpose, in order for us to calculate the taxable profit, tax say no, you need to take it out, hence we deducting it. We have also fines and penalties. Remember, for accounting purpose, we deduct it in order for us to get our accounting profit. But for tax purpose, in order for us to get the taxable profit, tax want you to put it back. Okay, we have a capital gain. Where did the capital gain come? You're gonna see the calculation a bit in details on the paper that on the document that is also linked here. However, just to go quickly, remember we sold our asset to 120. However, we purchased that asset to how much? To 100,000. Already, the difference between 120 and 100,000 is the 20,000. The 20,000 tax say, okay, I'm not gonna charge you on all the 20,000 tax. I'll only charge 80%. The 20% I'll never gonna charge it. And if you take 20% of 20,000, it's gonna give you 4,000. We have also a value of your depreciation plan, 20 the commissioning cost. You're gonna realize that that one, it was an exempt for tax purpose. Hence, we're gonna have the 100,000 divided by 10. It's gonna give you each and every year. You're gonna have a portion of 10,000, which gonna be exempt for tax purpose. Good. And all this one, when you do your math, it's gonna give you 2,000. Just quickly, remember, in our previous class, we say, what is a tax expense? Tax expense is the tax that we have based on the accounting profit. So in our case, our accounting profit equal to how much? Equal to 540. But this 540, we need to take into a consideration few adjustments based on temporary permanent difference. So based on permanent difference. And those adjustments based on permanent difference give us a 2,000 minus 2,000. So if you take 540 multiplied by 28%, it's gonna give you 151,200. If you take the 2,000 multiplied by 28, it's gonna give you 560. If you take 151,200 minus 550, it should give you a 150,640. And this 150,640, this is your tax expense. And remember, what is included in your tax expense? From our previous lesson, we said in your tax expense, you have two legs. You have the current tax as well as the deferred tax. That deferred tax can either be a deferred tax asset or a deferred tax liability. Good. Now, let's go to your temporary differences. Temporary differences, remember, for accounting profit, we took out tax. So we took out the depreciation, but now we need to bring back depreciation by taking out allowances. So depreciation, with all the calculation, it gives us 269,375. You're gonna see the calculation on the document that I'm gonna also upload. You have tax allowances, it gives us 345. Okay, we have the commissioning cost 11,550. The calculation also, I show how you calculate the commissioning cost. Okay, we have also the profit on sale of motor vehicle. You're gonna realize that the total profit on the sale of motor vehicle, it was actually 41,875 for accounting purpose. Okay, However, when you do your math, you're gonna find out that we need only we're supposed only to take into account 21,875. So we're gonna take the 21,875 by including the recoupment, and the recoupment is 35. How did we get the 35? You're gonna see again everything well on the document that I put, or the calculation are there. You can check them very well. Okay, now let's go to your prepaid expense for the current year and the prior year. Remember, for tax purpose, what it say? Tax say that you need to charge them the moment, okay, when the transaction happened. So for 2017, which is actually like the opening of 2018, we're gonna do what? We're gonna put it back, but we're gonna deduct the one for 2018, which is like the closing of 2018. Okay, when it comes to income received in advance for 2018, remember this is liability. For 2018, we're gonna put it back, and for 2017, we're gonna put it out. Remember, for accounting purpose, we did the reverse. So it's actually the reverse of what you did for accounting purpose. Now you're reversing them for tax purpose. Okay, provision is the same thing. It's also a liability. So what we did for accounting, we reverse them for versus what we did for tax. Okay, and when you do all your math, we realize that we have a taxable income of 492,050. Now, can you remember what was our accounting profit? Accounting profit was 540, but what is it? Our taxable profit? Taxable profit is 492. Okay, so already we can see there is a difference. And if you take the 492, you multiply by 28%, you get now your current tax expense. And the current tax expense is going to give you 187,774. Good. And remember, we got already a bit earlier, we calculated already our tax expense, which was 156.40. And the difference between your current tax expense, this is your tax expense, it's going to give you a deferred tax. We can also calculate the deferred tax by taking the total of your temporary differences multiplied by 28%. It's still going to give you this amount. Good. And then now you need to do your note. And for you to do your note of tax expense, remember what are included in your tax expense. What is included in your tax expense? You have your current tax. Current tax is the tax that we calculate based on the taxable profit. Okay, and the portion that's gonna remain, that's gonna be your deferred tax. Let's try to think. In this case, our deferred tax, is it an asset or liability? Let's just start to think. Remember what we said. We understand that we were supposed to pay actually 150, but tax say no, pay us now 135. So the remaining balance, we're going to pay it in the future. Isn't it a liability? Then it becomes your deferred tax liability. Okay. There is also a few calculations that you can do if you want to do any reconciliation of your rates. But I did not put them here because I did not really see them necessary. I wanted just at least guys to have a bit of an idea of how to answer the question. So I'm also going to upload with this video a document where I did by hand all the calculation. How did I get the depreciation? How did I get the allowance? So what you can do, you can just have the two documents and you can just follow along my calculation. And should you have a question, if you do something you did not understand it or you have a question, feel free to put a message on the comment box and I'll try quickly to answer and to put a clarification if needed. Thank you guys for watching again this video and really appreciate your support. Please, if you found that you really enjoyed the video, you can like it. You can also share with your friend who you think might be interested in this. And stay tuned. And each and every time we have a topic, we're going to try to make sure that we inform you. And please subscribe to the channel so that it's going to be a way of encouraging us. Once again, thank you and enjoy the rest of your day.